Fabulous. Okay, so good morning, everybody, or good afternoon, depending on where you are in the world. Thank you for joining us this morning. On behalf of Moore Kingston Smith, it's a pleasure to welcome you to today's session on exploring business opportunities in the Middle East. We're seeing increasing interest from the UK and European businesses looking to diversify markets, access new investment, and build partnerships in the Gulf region. Across sectors such as finance, technology, infrastructure, healthcare, media, and hospitality, the pace of development remains significant in the Gulf region, supported by national transformation agendas and sustained capital. However, entering a new market requires more than identifying the opportunity. Understanding regulatory structures, ownership models, the tax landscape, cultural expectations, and how business relationships are formed in practice is essential. Today's session is designed to help provide exactly that clarity. Moore Kingston Smith is part of Moore Global, a network of over 30,000 people in more than 110 countries. My name is Darren Jordan, and I lead our international services here at Moore Kingston Smith, a multidisciplinary advisory, tax, and audit firm with expertise across multiple sectors and a part of Moore Global. The value of this network is practical. Our clients gain access not only to technical expertise, but to advisors who understand the commercial and cultural context of their own markets. So when organizations expand internationally, they are not stepping in alone, they are stepping in with a trusted partner already in place. One of those partners is Moore JFC, our member firm in the Middle East. Their team has deep experience across the Gulf Cooperation Council region, supporting market entry, structuring, tax and regulatory compliance, and ongoing business operations. They work extensively with UK and European businesses and will share insights today drawn from real on-the-ground experience. Our aim is to give you a clear, practical understanding of how to evaluate and approach opportunities in the Middle East. So whether you are in the early stages of exploration or preparing for concrete next steps, we hope you leave today better informed and well supported. Thank you again for joining us. I'm going to now hand over to Akriti from Moore JFC to begin with the regional overview.
Thank you so much, Darren. Good morning, everyone. It's a pleasure to be here this morning with my colleague Darren and also my colleagues Swami and Gerald from Moore JFC. My name is Akriti. I am a partner heading the business consulting service line with Moore JFC, headquartered in the UAE. Our firm is regionally present in 6 GCC countries. So Bahrain, Qatar, Saudi Arabia, Oman, and United Arab Emirates. As we progress through the webinar today, I'll be taking you through a quick overview of what GCC really entails, a region that's truly positioning itself as an exciting business hub globally. As we progress through today's session, my colleague Gerald will speak to you about some emerging and exciting trends in the Middle Eastern market. And then my colleague Swami will follow this through with the current tax environment in the GCC that has seen some tremendous reform over the last 5 to 8 years. We really hope that this session gives you a useful snapshot of what it means to engage with the Middle East and operate in this fast-paced and ever-emerging and evolving region. So if we can go to the first slide, please. I'm not able to see the slides on my screen, but hopefully the participants and the attendees are able to see that. Can someone just confirm? Darren, are you able to see the slides?
I'm not able to see the slides.
I can't see the slides. Oh, here we go.
All right, there we go.
So, Gerald, you just need to put it into presentation mode. There we go.
Perfect. Thank you very much. So like I said, that before we really delve into today's webinar and discuss what operating out of the region really looks like, it's very important to give a quick overview on what really is the GCC. GCC, or the Gulf Cooperation Council, is a combination of 6 Middle Eastern countries, as you can see on the screen: Saudi Arabia, United Arab Emirates, Kuwait, Qatar, Oman, and Bahrain. And over the years, GCC has really evolved into one of the most dynamic economic blocks in the world. And I think what makes it truly a region that is positioned for global growth is that it's a natural gateway between the East and the West. Over the years, the entire region has moved from a very traditional thinking, and they've become very progressive, both in terms of providing a world-class infrastructure, a safe and progressive standard of living. And what that has done is, over time, that it's brought to this region a readily available and ever-growing talent pool of expats, thereby pushing Western counterparts and helping them want to set up in this region, and expand into getting that very strong link into Asia and Africa. I think one thing that's extremely exciting and also interesting is that in the past 5 to 8 years, GCC as a region has really evolved beyond just being an energy hub. They have diversified by being from being an oil economy to now investing heavily into technology, logistics, financial services, and sustainability. So what that really means is that the region is now more than ever ready to become a global hub for growth and investment. To put this all into perspective and weigh it against some factual numbers, we will talk about in the next slide the IMD World Competitiveness Rankings. So as you can see on your screen now, we've looked at the competitiveness rankings for 2024, which assesses, so IMD ranking assesses about 67 economies based on economic performance, government efficiency, business efficiency, and the numbers here really tell a story. They really factor in and factually present what I've just said about the GCC becoming a hub for global growth and opportunity. As you can see, that the UAE ranked 7th globally in 2024, and it's up 3 places. UAE has also been a sort of a top rank contender in the Arab region for almost last 8 years in a row. We've seen Saudi Arabia and Qatar both move up to higher rankings. Qatar being on the 11th position and Saudi Arabia being on the 16th. And the more traditional economies, but still just as engaged towards this combined GCC growth, Bahrain, Kuwait, and Oman have also shown notable improvement in their rankings. Why it's important to look at numbers is that they tend to support the theory and reflect that the governments in these regions are focusing on are not just focusing on infrastructure and regulation anymore. They've crossed that step in their growth journey, and they are now really looking at efficiency and innovation that then translates into things like very attractive visa residency programs, business-friendly policies and reforms, thereby making this region more than ever attractive to global investors and Western counterparts. Next slide, please. So what we've just talked about, the region, its ranking, its growth potential. I think let's just take a step back and now really look at it from a global and regional context, and asking why does all this matter? So from a global perspective, it's very important to know that we are looking at a region that offers a highly effective business environment, and that could be how easy it is to set up a company, access credit, secure permits, enforce judicial contracts. And from a regional perspective, the GCC countries as such, irrespective of their differentiation in terms of growth potential, traditional mindset, they are all aligned with a growth trajectory for the next 10 to 20 years through their various Vision 2030, Vision 2040 programs, where they are really looking to diversify these economies and do so with a mindset of innovation and long-term sustainability. And ultimately, all of this leads to a major potential, a major opportunity for Western businesses. It opens a major door for foreign direct investment into these regions, and really bridges that bridge between East and West. Wherein expanding into Middle East could mean an access to the wider African and Asian markets, and seamlessly, and how seamless it is for companies to operate out of the region. So that is a short introduction in terms of the GCC region as such, and its current standing in the global markets. I will now hand over the mic to my colleagues, who will speak a little bit about the emerging trends in the Middle Eastern market. As we progress, if you have any questions, please feel free to put them in the Q&A or the chat box. We'll be very happy to take these on towards the end of the webinar. Over to you. Thank you very much.
Thank you, Akriti. Good afternoon, everyone. Over the next few minutes, I will highlight some of the most transformative trends shaping in the Middle East and the exciting opportunities they present for the investors. Since there is a lot of developments happening in the Middle East, I have selected three most important emerging trends for this webinar. Firstly, on technology, AI, and digital transformation. We have seen that the region is undergoing a rapid digital evolution. The governments are leading their investments in AI, cybersecurity, cloud infrastructure, and smart cities. Some of the projects that I would like to highlight are the Saudi Arabia's NEOM, Dubai's Smart City, and Qatar's digital government. Also, I would like to highlight that the fintech is thriving. Digital banking, mobile payments, and blockchain applications are expanding rapidly in the region. Next, on the sustainability and clean energy. As you all know, that sustainability is now central to the national agendas. The Middle East is emerging as a global leader in green hydrogen, solar energy, and carbon neutral construction. Also, the UAE has hosted COP28, which is accelerated ESG adoption and climate commitments across the region. Also, we have seen that the sovereign wealth funds are actively investing in the green infrastructure and transition projects. Finally, on the private markets and family offices, we are seeing a significant shift in private capital dynamics. Prominent family groups are professionalizing governance and succession planning. There is a notable rise in regional private equity and venture capital, with family offices establishing in multi-jurisdiction structures in the hubs like DIFC, ADGM, Doha, and Riyadh. So now, what are the opportunities does the GCC market present, and what does the future outlook look like? I will focus on key four factors in this slide. Firstly, on the economic diversification. As you all know that the GCC is undergoing a rapid transformation, moving beyond from its traditional reliance on oil to focus on sectors like technology, tourism, and renewable energy. To support this, the government has come up with flagship initiatives such as Saudi Vision 2030 and the UAE Green Economy Strategy, with large-scale investments in infrastructure, education, digital ecosystems. These diversifications is creating new ventures for foreign investment, entrepreneurship, and sustainable growth across the region. Next, on the regional integration. We have noticed that the GCC is strengthening its regional attractions through initiatives aimed at customs union, unified regulations, and cross-border logistics connectivity. So the regional integration helps in streamlining the trade, reducing the barriers, and enhancing the movement of goods and services across the member states, making the region more attractive for multinational business and supply chain operators. Next, on innovation and technology. Across the region, we are witnessing an extraordinary surge in fintech, artificial intelligence, and blockchain applications. This isn't happening by chance, but it is through proactive government policies. From the digital banking platforms to AI-driven healthcare solutions, the GCC is positioning itself as a global hub for the next generation technologies. So let's take a look at the scale of ambition. So firstly is on the NEOM in Saudi Arabia. It is not just a city, it's a vision of the future, integrating AI, robotics, and sustainable living into everyday's life. In the UAE, the smart city initiatives are transforming Dubai and Abu Dhabi into a digitally connected ecosystem where data drives efficiency and sustainability. Qatar's digital government program is setting benchmarks in the e-governance, ensuring seamless services for citizen and business. Finally, on the investor-friendly policy, when we talk about the opportunities in the GCC, one of the most powerful driver is the policy reform. The region isn't just opening its door to investors, it's redesigning the entire business environment to make entry and growth seamless. Over the past few years, GCC governments have rolled out bold reforms aimed at attracting foreign direct investment and fostering global partnership. The free zones have expanded and offering tax incentives and also 100% foreign ownership. The business process setup has been simplified. So in short, the GCC is sending a clear message that we are open for business and we are here to stay. With reforms that lower barriers, expand opportunities, and strengthen global ties, the region is shaping a future where investors can scale and contribute to the sustainable growth. I'll now hand over to Akriti to continue with the next slides.
Thank you, Gerald. So now that we've looked at the big picture and what this region has to offer, let's zoom into some of the key indicators that make GCC such a business-friendly region. And following this, we'll discuss a little bit about the regional reforms as well as what a classic company setup or a business setup in the GCC looks like, looking into consideration the various regions that we've just discussed. So the very first sort of indicator of ease of doing business in the Middle East region is the ease of market entry, which is extremely streamlined thanks to the highly developed free zone ecosystems that allow 100% foreign ownership, simplified incorporations, and VIP setup services should that be needed. The region also comes with competitive tax regime. It is no longer in the gray jurisdiction of OECD list. It has now completed all its reforms by the Western regulators. So it has become ever so important now that this region can support all the banking reforms that the Western economies keep at a very competitive scenario. The corporate tax regime, while has evolved in the past few years, they are extremely competitive, and there is no personal tax currently in the GCC countries. It's also important to note that there is a strong capital mobility in the GCC region, wherein expatriation of profits, personal gains, etc., is not limited to a certain threshold. There is no taxation on that repatriation of those capital amounts. It's also key to understand that the GCC states and their currencies are pegged against the US dollar, so they do come with stabilities, which is very important in terms of gaining investor confidence and predicting how the markets will operate. The region has also evolved. Sorry, Gerald, if you can just go back. Thank you. The region has also evolved in the last 5 to 8 years when it comes to developing and sustaining a robust financial sector and banking infrastructure. There are some large commercial banks in the region that now have presence through representative offices or branches in the Western world, specifically in leading cities such as London, New York, because that is the kind of traction that they are getting. They have clients that require their services in the Western world as well. It's also important to know that the region really understands and gives importance to innovation and the digitization of our day-to-day operations, be it personally or as a business. Over the past 2 years, if I have to take an example, UAE has approved through its central bank 2 large digital banks, of course, powered by 2 large commercial banks in the region. And these digital banks have made it seamless for investors to open bank accounts in these countries. And this is a trend that is now surging forward from the UAE into the Saudi market, as well as Qatar. And we see this trend progressing in the next 5 years, also to the other states of the GCC. And this means that there is a scope for not just traditional business owners and corporates, but also the new age billionaire CEOs for wanting to set up their business and grow within this region. GCC as a group, as a council, also prides itself in having an extensive double tax treaty network, and that just means that businesses that are operating out of this region have far more scalability when it comes to being tax efficient using these extensive DTT networks. Specifically with UAE and KSA being such large economies, and UAE specifically being an economy that is supported by ports, this is a great opportunity for businesses that are into retail, trading, manufacturing, to ensure that they utilize this large scale port, air, and transport facility, and really have an efficiency when it comes to logistics and customs between the GCC network as well as the wider African market, which is where there is an opportunity for significant growth. And lastly, over the last few years, the GCC Council as such has really looked at its judicial reforms. There are several free zones now. The Qatar Financial Center, based in Doha, Qatar, ADGM and DIFC based out of UAE, that have now adopted their regime to operate as per common law. And this has become very attractive for Western region, so that if there are any inhibitions wherein businesses are not sure whether or not the Sharia law will apply to them, these sort of reforms and initiatives make it a lot more positive and giving confidence to these investors wanting to operate and grow their businesses through the GCC through the GCC region. Next slide, please, Cheryl. So this slide talks a little bit about the regulatory and legal framework, which will tie in with what I've just presented in terms of doing business in the GCC and the ease that it presents to the investors. The business registration process as such is extremely streamlined. There is an extensive and vast amount of information that is available through the government websites, through free zone newsletters, roadshows, and this means that the investors and the companies, Western companies that are looking to move into the market, are a lot more informed and aware of what that process looks like. Most GCC free zones operate through a centralized digital portal wherein all company requests can be submitted. So this means that they have digital and innovation at the centerfold when it comes to creating initiatives and supporting investor growth. like I mentioned, that for licensing requirements previously, most regions, including Saudi and UAE, were heavily involved in activities that required a national presence. For example, a Saudi partner for a certain percentage, or an Emirati partner. While they might be a nominee or a shadow partner, but that compulsion was there. However, over the last 5 to 8 years, and more recently in Saudi Arabia through its authority MISA, they have regularized this, and they have opened up foreign direct investment in major activities and sectors where this compulsion is no longer applicable, and licensing requirements have been laxed and are now open, barring a few specific activities that still require or might require a presence of a local partner. They've opened the floor for 100% expat ownership in 95% of the economic activities that are available in these regions. And lastly, like I mentioned, that over the last few years, they have really looked at the judicial reform. Many authorities have adopted common law, and keeping this in mind, there are dedicated commercial courts and arbitration centers now. For example, DIFC, ADGM, DIAC in UAE, and SCCA in Saudi, that are focusing on contract enforcement efficiency, and are supporting businesses and individuals with faster dispute resolution should they find themselves in that scenario. Next slide, please. Sorry, pardon me for that. So this brings me to the last slide in my session, which basically details a typical company setup or an incorporation process in the GCC. Now, of course, the process may differ slightly depending on which region you're operating out of, whether it's Saudi, UAE, QFC. However, inherently in terms of the documentary requirements, the process, they remain pretty much the same. So we wanted to present what a typical process might look like. However, this might differ depending on the activities chosen and the region or the authority that you operate out of. For any business looking to enter the Middle Eastern or the GCC market, it's very important, specifically now more than ever, given that there is corporate tax, value-added tax, excise tax in all of these GCC countries. While the tax percentage itself might be conducive to doing business, however, the required the required process and compliance remains the same as it would be in the Western world. So it's very important for companies or businesses looking to move into the region to really understand and scope out what their activities and what their main aim is when looking to move into the Middle Eastern market. It's important to understand the business activity. It's also important to identify and work out on your legal structure, making it conducive both in terms of local taxation, but also the tax and the regime that is applicable to you, given your parent company. Could be Germany, could be the United Kingdom, and this first step would define or give you an outcome that you have a clear roadmap in terms of where you wish to set up free zone, mainland, UAE, KSA, and how this setup would progress. The second step in the journey begins with your reservation of your name and your activities, understanding what compliance documents you need to provide for the ultimate beneficial owners, as well as the shareholders, directors, and the operative managers who would be taking care of the entity locally in the UAE and other regions. It's also important to note here that given its given that the region is wanting to operate when it comes to compliance and regime like the Western world. In 2020, the region has also implemented an ultimate beneficial ownership regime, wherein the details for the ultimate beneficial owner, even in a nominee structure, must be declared to the national government. However, this information is not of public knowledge, so this is still a major highlight and positive point for a lot of investors, that while the information needs to be submitted to the relevant authorities, the law does not make it public unless it is required by court of law. This step also entails looking at your requirements when it comes to office space, processing of visas for employees that would be working under the company. Most GCC regions require you to have a visa to work out of the country. Most expats are on employment visa. There is also a possibility now to obtain golden visa through the premium residency programs. However, most expats that are living and working out of the UAE would be sponsored on an employment visa by the company. So it's important to understand how will the company work through this requirement once the company is incorporated. So the stage 2 really must mean that the business activity is approved, the name is secure, and the business is now ready to move to the final step, which means getting the company up and running and getting those documents ready for you to progress to the next step. We come to stage 3, which is your licensing and establishment stage, wherein your license, along with the various supporting documents such as your memorandum and articles, your lease documents, are issued by the relevant authority. You then progress in obtaining some very important documents such as your registration with the Labor Department to support getting your employees impaneled and processed under the company. And now the company is completely operational in the government systems. It is now also important to ensure that any regulatory compliances that the company needs to comply with, for example, in the UAE, it is important for an entity to get registered with the Federal Tax Authority for corporate tax within 3 months of its incorporation, and failure to do so could lead to certain financial penalties. A similar case in Saudi, where after incorporation, you must register with the Ministry of Human Resources, Zakat, which deals with withholding tax, VAT, as well as corporate tax. And these all need to be done as soon as the entity is licensed. Once the entity is licensed, we move to the last stage where the workforce can be mobilized, as well as the company can now start its operation by opening a bank account. The banking regime, as compared to a lot of the Western economies, has gone through a major overhaul. You could open a bank account in the Middle East in a matter of 2 days, which has now progressed to a little bit longer timeline, but only because there has been a thorough and a major move in terms of the compliance when it comes to anti-money laundering regime in the region, and the banks have become extremely thorough in terms of getting the CRS FATCA overviews, and doing thorough checks when it comes to investors and their companies. So the company is now ready to transact. As a last point on doing business in the GCC, I think it's important to highlight that as these are all expat-driven economies, they are mindful that they need to also have space for their own nationals to grow and work in the market. And keeping this in mind, most economies have come out with labor programs. For example, Emiratization in the UAE, which requires entities with a certain percentage of employees to employ Emiratis in a 50 to 1 ratio. So, for example, if you're a mainland entity with 50 employees, for every 50 employees, you need to employ 2 Emirati employees, and so forth. While the regime in the Emirates and in Bahrain and Oman are still fairly flexible, However, Saudi has been quite stringent when it comes to Saudization. They are, sorry, pardon me, they are, however, looking to streamline this and make it a little bit more investor friendly. But these initiatives in terms of Saudization, Omanization are very much prevalent, and we foresee that these initiatives or these regimes would want to work seamlessly with new investors wanting to set up in the wider GCC region. That's all from my side on the webinar today. And now over to my colleague Swami, who is going to speak a little bit more in detail about the current tax regime in the GCC countries, and specifically break them into various taxes that are now prevalent, and the various percentages and compliances attached to these taxes. Swami, over to you.
Thank you, Akriti, for that wonderful regulatory overview, which is the base for discussing taxes as such in the region. Good morning, good afternoon, good evening, everyone. That's I know people have joined from different parts of the world. It's all three zones. It's fantastic to be here and provide an overview about the tax regime in the region as such. It's as Akriti mentioned, in terms of ease of doing business, in terms of the proactiveness of the government to facilitate a business friendly environment, in terms of whether it's in terms of the ownership structure or in terms of the exchange controls. It's very evident that government in the region wants to encourage investments. As you may all be aware, it's not just about the foreign direct investment into the region. There are significant outward investment as well. So that some of the companies, some of you are from companies which are being funded by some of the large family offices or the funds that are set up by the government as such. So coming to the tax, Middle East is not a 0% tax rate region as such. There's a lot of times when people talk about it, they talk about saying that Middle East, oh, it's 0% taxes. 0% taxes is largely applicable for the individuals who are not carrying out the business, who are employed or making investments as such, in larger part of the Middle East as such. The businesses that are carried out are subject to tax. Middle East countries, just specifically GCC, they're all members of the OECD inclusive framework. Along with another 135 countries as such. That's okay until maybe some technical issues with the slides as such. We'll come back to the slides.
Swami, if you just if you don't mind continuing, he'll just take a minute.
Yeah.
He's just reconfiguring. I think he got kicked out of the webinar for some reason, but
No problem.
if you just allow him a minute.
Yeah, sure. So all the GCC countries are members of the inclusive framework. So what does that mean? That means all the countries at some point in time will get into the Pillar 2 regime, the large corporates as such, which are present beyond one jurisdiction. Which means that effectively there could be a 15% tax on these companies. But for the other companies which are not as large, for whom the Pillar 2 applies, still the tax rates are very, very competitive. For example, in UAE, we have a 9% tax. Then if you move to Qatar, it's 10%. If you move to Saudi Arabia, it's 20% taxes. Kuwait, it's 15% taxes. Same with Oman, it's 15% is the rate of corporate tax as such. VAT, although there is a GCC framework for introduction of VAT, some of the countries are yet to introduce VAT within the region. The countries which have introduced VAT, UAE and Qatar have the lowest rate, which is at 5%. Saudi Arabia has the highest, which is at 15%, and Bahrain at 10%. Bahrain has not introduced the corporate tax yet. There is a proposal to introduce corporate tax at 5%. So this is a
sorry,
yeah,
Swami. Can I just ask? There's a question in the Q&A that asks about the tax rates for free trade zones.
Free zone, yeah, yes. I'll come to that, Darren. Thanks for that. I saw that question. So it's not a straightforward 0%. I'll come to that. I'll dwell a little more in terms of the free zone specific aspect as such, Amit. Thanks, Darren, for highlighting that. So when these are the larger rates as such, how the taxes work, what are the tax rates within the region. When we get into the specifics of each of the countries, it's as Akriti was mentioning, that it's not just about the corporate tax and the VAT. There is excise tax, there is customs as well. In some cases, in some countries, there is withholding tax. So all this, there are taxes are very local, right? Other than the global minimum tax that we talk about. That being the case, it's very important that in each country, taxes or the compliances needs to be understood. We are trying to give an overview of how the tax environment works with the background that it's all the civil laws that are applicable in the region as such. It's not a common law, as Akriti was mentioning. It's only a few designated areas where the common law is applicable, like DIFC, ADGM. In Qatar, it is International Financial Center. So these are some of the regions where the common law would be applicable. Gerald, can you move to the next slide, please? Gerald, Akriti. Yeah, thanks. So if you look at Saudi Arabia, although I did mention the corporate tax rate as 20%, there is zakat also, which is a tax, or rather it's not exactly tax, but then it's considered within the taxation system as such, even by the OECD. Zakat is based on the religious scriptures. It's as per the religious commandment as such. It's 2.5% zakat will be applicable on the net worth as such. So this is for the companies which are held by the GCC shareholders as such. For the non-GCC shareholders, the corporate tax, it's not the zakat that will be applicable. It is the corporate tax that is applicable, which will be at 20%. As I was mentioning, in terms of personal taxes, there is no personal income tax as such. If you are earning income from salaries, wages, or investments, that's not something that is subject to corporate tax or the income tax as such. There is a withholding tax in Saudi Arabia, which ranges from 5 to 20%. As Akriti alluded to, there are a lot of treaties, international treaty network that is there. Withholding taxes, you can take advantage of the treaty rates wherever it's applicable. And then in terms of the loss carry forward, there is a indefinite time period that is allowed for loss carry forward. And there is also something called the regional headquarter regime, which has been introduced recently. I'll spend a little time on that, which may be of interest to you in case you are looking at Middle East as the market and want to set up a regional office as such within the Middle East. Then the other taxes that are applicable are VAT, which is at 15%. Excise tax has a limited application. Excise tax is generally applicable on the aerated drinks and the sweetened drinks as such. It varies from 50 to 100%. In some cases, it's on tobacco as well. The capital gain tax rate remains same as the corporate tax rate of 20%. In terms of Pillar 2 regulations as such, Saudi Arabia has not introduced Pillar 2 regulations. As I was mentioning, Saudi Arabia is also part of the inclusive framework. Saudi Arabia is part of the inclusive framework countries. Saudi Arabia has entered into 50+ tax treaties as such. Now, moving on, just spend a little bit of time in terms of what is regional headquarter program. So this is a program that has been announced by the Saudi government to encourage companies to set up the regional headquarters. Now, to encourage, as part of the encouragement, the government, it's along with the regulatory measures in terms of the faster clearances, faster approvals, and all that, which Akriti did mention about 100% ownership, all this. There are also some tax benefits, which is a 30-year no taxes on the income that you generate from the regional headquarter program as such. So 0% corporate tax. However, all the 0%, one of the important aspects that needs to be kept in mind is that any benefit that government gives, government expects some compliances in terms of the conditions that needs to be fulfilled. I also saw a question in terms of an virtual office. If I have to link that up with a regional headquarter program or any tax benefit regime as such, is that it's one of the important aspects from the tax is the substance, establishing substance. It's not just about gone are the days where just an entity can be a post box number and with the incorporation in a particular country and then income getting accumulated in those. Gone are those days. Now the tax authorities around the world are insisting on substance. If there is no substance, it may complicate in terms of where the company gets operated and managed from. But if the management shifts to, let's say, a UK company, it's a UK shareholders have incorporated a company in another jurisdictions, any other jurisdiction without any office, people functions for that entity, then the possibility of UK authorities saying that, okay, this is a controlled foreign corporation or some company which is controlled from UK, so it is subject to UK taxes, irrespective of where that entity is incorporated. Darren should be able to spend more, explain more on that, and then most of you would be aware. This is something it's in terms of place of effective management aspect that needs to be considered. In terms of the RHA, it's as I said, it's to attract the foreign direct investment and to look at the regional, provide a regional control or the management as such by the Saudi government. So you need to have people performing these roles. There are in terms of the exemptions and Saudiization rules that were Akriti was mentioning. So there could be some exemptions on those. There could be some exemptions in terms of visas, along with the withholding taxes on the payments that gets made. So it's not just about the tax benefits. There could be other benefits. It's in terms of the regulatory compliances and the regulatory benefits as such. It's a fantastic program in case you are looking at setting up a regional office. It's not necessarily within the region. It could be even beyond the region as such. It has to be a management office as such, which needs to be staffed, and then people should be performing the management role. Can we move on to the next slide, please? Qatar, it's now moving on to Qatar. The rate of tax in Qatar, corporate tax rate is 10%. As I was mentioning, there is no withholding tax regulations yet in Qatar. You may be aware it's before the World Cup, last FIFA World Cup finals, or the FIFA World Cup tournament as such, there were talks in terms of bringing VAT in Qatar. Qatar is also part of the GCC VAT framework, some agreement, that's a framework that has been drafted. However, till now, VAT has not been introduced by the Qatar government. Corporate tax has been there. It's been there for a while. The rate of corporate tax is 10%. One important aspect along with the corporate tax is that all these countries have transfer pricing regulations, which are essentially modeled on the OECD regulations. And there has been cases where the transfer pricing audits have been carried out, and in some cases tax adjustments or the transfer pricing adjustments have also been made. It's important in terms of looking at the transfer pricing documentation, documenting the functions, assets, and risk in case it is not done, or a company looking at setting up operations within the region. It's important to look at what the transfer pricing compliances are and where do you stand in terms of transfer pricing compliances as such. In terms of the other corporate taxes or the personal taxes aspect as such, it's 0%. There is no personal taxes as such. And then in terms of loss carry forward, there is no limit. Withholding tax is at 5%. There is also special regime. It's like the free zones or the financial center in Qatar, similar to UAE and KSA. Not necessarily on the regional headquarters, but otherwise in terms of the free zone as such, where you can have 100% foreign holding and the rate of tax could be 0. VAT, it's as I said, it's 0%. Excise tax, similar to other jurisdictions, as 50 to 100% on the sweetened drink or at some carbonated beverages. Capital gain tax rate remains at 10%, similar to the corporate tax rate. Pillar 2 regulations are yet to be implemented. And Qatar IFC has more than 80 plus double taxation agreements as such. Gerald, can you move to the next slide, please? Thank you. Bahrain is yet to introduce corporate taxes. Bahrain has VAT. Bahrain levies VAT at 10% as such. Excise is the same as the other jurisdictions. And in terms of the corporate tax rate, as I said, it is 0%. However, Pillar 2 regulations with respect to qualifying domestic minimum tax, QDMTT, has been introduced. No other rules have been introduced. So as of now, it is qualifying domestic minimum taxes as such as something that it's there as part of the regulations, introducing the global minimum tax. Carry forward of losses are allowed. No personal income taxes as such. It's there could be a withholding tax which is at 0%. And there is a treaty network of more than 40 countries in Bahrain, but then all this would be relevant once the regulations get introduced. Regulations have been announced saying that it will be 5% tax on the business profits, but at the dates from which it will be applicable and the related regulations are yet to be announced as such. Can you move on to the next slide, Gerald? Oman has a corporate tax rate of 15%. It's in terms of the personal taxes, there is a proposal that there will be a personal tax at the rate of 5% on people earning salary income as well, which is above 42 million Omani Riyal. That's 42,000 Omani Riyal, which is approximately less than $150,000. So little less than $150,000. Anybody earning about $125,000 upwards will be subject to 5% tax as such. That is from January 1, 2028. As of now, there are no taxes. That's the proposal that is there. There is no regulations yet. Corporate tax rate is 15%. Carry forward losses is something that is allowed. There are withholding taxes at the rate of 10%. In terms of the other taxes, it's similar to the other jurisdictions, VAT being 5%, excise tax is 50 to 100% on the categories. It's carbonated drinks, it's sugar, tobacco, all this attract excise tax. Customs is at 5%, similar to other countries within the jurisdiction. Treaty network, it has more than 36 country treaty network as such. BEPS Pillar 2, again, it's only QDMTT, which is applicable from January 1, 2025. Can you move on to the next slide, Gerald? Thanks. Kuwait also is similar to other jurisdictions within the GCC. Carry forward of losses, no personal income taxes. Withholding taxes, it's at 0%. It's the corporate tax is at 15%. Customs rate, excise, there's no value added tax as such. And in terms of Pillar 2, it's the QDMTT that is applicable. Treaty network is more than 35 treaty partners as such. Coming to UAE, it's General, can you move on to the next slide? UAE, the corporate tax rate is 9%. I'll come to the 0% part that's a little later. Special regimes or the free zone regimes, there's no personal income tax. Anyway, withholding tax, as of now, it is 0%. There's no limit in terms of carry forward of losses. Other taxes, as I was mentioning, it's VAT, excise tax are there, customs is also there. Then capital gains tax rate is also 9%. And in terms of the Pillar 2, BEPS Pillar 2 applicability as such, it's only QDMTT has been introduced from January 1, 2025. Treaty network, the largest treaty network, it's more than 130 countries, which are effective treaties could be more than 100, 110 as such. Now, coming to 0% taxes as such, free zones can be eligible for 0% tax. 0% tax, it's, as I was mentioning earlier, any benefit that is provided by the government expects certain conditions to be fulfilled. So what are those conditions? It's when we look at free zones as such, it's there are two very important aspects that needs to be looked at. One is in terms of the qualifying activity. 0% tax rate is applicable for the entities which are carrying out qualifying activity as such. And the income that gets generated by these qualifying with these free zone companies have to be qualifying income as such. Now, what are the qualifying activities which can be subject to 0% taxes as such? There are other conditions. These are the main, these two are the very important aspects. You will get into the others only when you fulfill these two important aspects as such. Daryl, can you move to the next slide, please? So in terms of the qualifying activities, it's we can largely look at it as three distinct categories. It's and then one which is a residual category. These activities, it could be manufacturing, processing, distribution as part of goods and materials sale as such. Then in case where you have related party transactions or you derive income from related party transactions, it is the headquarter services or the treasury services and the financing services. Then the activities which are subject to regulatory overview, which could be reinsurance, fund management activity, wealth and investment activity, as investment management as such. Others could be holding of shares and other securities, which is the holding company activity. Ownership, management of ships, finance and leasing of aircraft. So this is some ultra high net worth individuals or their companies having owning ships and aircraft. And logistics activity as such. So companies which are carrying on these activities, they can be a qualifying free zone entity as such. Just by virtue of, Hamid, to your question, an entity getting incorporated in a free zone, whether there will be a 0%, they will be subject to 0% tax. No, it's the first thing is to look at what the entity is doing, whether the activities that are carried out by the free zone entity, whether it will fall within this one of these activities as such. Can we move to the next slide, please? In terms of, go back to the previous slide, Jared. Thanks. So in terms of previous one. So qualifying activity is one of the first conditions. And the second part is in terms of the qualifying income. The income that you generate from these entities which are incorporated in the free zone have to be carrying out one of these activities. So the income has to be from these activities. It's if, for example, there are ancillary activities that are related to the main activity. If the income is generated from those activities and it is beyond 5% of the total income, then the free zone benefit or the 0% taxes will not be applicable. Other conditions includes establishing, you will have to have substance. It's first and foremost, the free zone entity should have substance. What is substance? Is in terms of you should have premises. It's within the free zone. You should have people performing the functions or the activity qualifying activities as such, and then it's you will have to carry out the activities from the free zone as such. So if you have an entity incorporated in free zone but do not carry out these activities, or the decisions are made elsewhere, the activities are carried out elsewhere, you may not be eligible for free zone benefit. With respect to distribution of goods, there is a little bit additional conditions. It's in case of a trading or a distribution activity that one need to keep in mind. That is in terms of the distribution activity, there are only very few free zones which are a designated free zone for the distribution activity. Any activity carried out within these free zones, within the designated free zones, only those activities will it be eligible for 0% tax benefit. You will have to, the entities which want to claim the 0% tax will have to maintain the financial statements, audited financial statements. They will have to maintain those financial statements as per IFRS. They will have to ensure that any intercompany transactions are undertaken at arm's length, along with fulfilling the other conditions that are provided under the free zone regulations as such. There is a 0% tax, that is entities incorporated in free zone, they may be eligible. However, subject to fulfillment of the conditions, those entities will be eligible for 0% taxes. This is an overview in terms of the taxes in the region. It's in terms of how we can help you is in terms of the tax services. It's helping you in terms of evaluating the region from your tax follows the business. So business activity, if you see the moment you see that there is a good opportunity for setting up the business in the region, you can definitely evaluate the taxes. Largely tax rates, you have seen tax rates are very, very competitive in the region. And within that, you still have leverage in terms of improving the efficiency of the effective rate of tax. So from that perspective, we can definitely look at the entity structuring. It's where the entity could be operating from, where you can get the tax benefit as an added advantage to the commercial business plans that you have already. So from that structuring perspective that we can help, you can look at family offices set up from the succession planning purposes or from the investment purposes out of the common law jurisdictions. We can also support in terms of if you have a target and looking at acquiring those targets, we can help you with the tax due diligence, whether all the compliances have been taken care by those target entities, whether if there is any risk in terms of the non-compliances or the tax models that are being implemented. We can also help in terms of the repatriation tax impact on it, in terms of the investments, what could be the best structures We can also help in terms of the pillar 2 advisory, computations, compliances. We can help develop transfer pricing policies. We can also help in terms of the implementation and documentation of it. We can help with all the tax compliances, direct, indirect taxes. We can also help in terms of just in case there are any challenges that you would want to get an advance ruling from the tax authorities. We can help you with that in case there are any audits. Once you start the business, if you are subject to any audits, we can support you with the audits as well. We move to the next questions. I'll just pause here. If there are any questions, I would be more than happy to take it. Darren and Akriti, over to you.
Thank you very much, Swami and Akriti. That was fascinating. You have just put in there a colossal amount of information in a very short space of time with some very good, very helpful slides. It certainly opened my eyes up to, I guess, what an overarching and holistic approach the GCC is taking to making itself attractive for new businesses. So obviously there's a lot of detail in there, but just holding that to one side for a moment, when it gets to actually practically living this and setting up in the GCC, what are some of the common challenges that businesses face that are either the unexpected challenges that people often come across when setting up in the GCC? I'm relaxed as to answers.
Thanks for that question, Darren. And I'll try to answer this as best as I can, because it is not in terms of whether or not people are prepared for what the process entails. It's simply that the region operates a little bit more differently than the Western world. And by that I mean that something as specific as setting up an entity with a corporate shareholder. Now, this would mean that you would need to provide corporate shareholder documents with the appropriate attestations, and these attestations could take time because it requires a stamp of the embassy of the parent company's jurisdiction. So I think a lot of times these nuances, which might not appear in the bigger picture, might take a little bit longer than anticipated. Also, something simple like a dependent visa. So a lot of times people don't factor in that if they're moving with their families, they would need to get a visa for their spouse, for their children. Children can only go to school when the visa under the father's sponsorship is done. Even though the regime and the countries have progressed significantly in terms of letting people live together before marriage, things that were not possible. But there are still certain nuances, not so much procedural to set up the entity, but more to do with how the region operates. I think that sometimes surprises people. But overall, the region as such operates without bureaucracy. So if you go to a government organization, if it's something that's in the rule book, something that they've progressed with, you will sort it out. But if you do reach a hurdle where it's something new, you're dealing with an aspect that they themselves have to look into and get you a solution, I think that can take a little bit longer. But overall, in terms of the procedure to set up the entity as such is fairly streamlined. It's just certain aspects of that process that can possibly catch you by surprise.
Okay, interesting. And are there any other aspects to sort of cultural differences which maybe people from the UK or Europe struggle with?
Absolutely. That's a very, very important and very relevant question. In the wider social media, the Middle Eastern region is always portrayed as someone that needs to cover up, etc., and making it mandatory. That's not the case, not even in Saudi. Saudi, over the last 5 years, has completely opened up. So now women can travel freely without a male guardian, be it your father or your husband, your brother. They're allowed to work, they're allowed to drive. when I go to Saudi, I don't need to necessarily cover myself with the hijab or the abaya. Of course, there are certain cultural bits that as expats we need to respect. One of them being that you cannot freely drink on the roads. There are many licensed organizations, institutions here, but that is something which I think as expats and most people that move to this part of the world are aware of that, and they're very happy to respect that. But more so in terms of what's being portrayed, that can I hold hands in public? Can I go to the beach? Absolutely none of that. It's just simple aspects that if you are going to a mosque, even if as a cultural activity with a group of friends, you might have to cover up. If you're in the mall, you might have to dress decently. But otherwise, in terms of how Middle East is portrayed in social media and in films, that's really not the reality, I would say. I think culturally they've progressed significantly, yet keeping their historic and cultural roots still very much at the cornerstone of how we operate through this region.
Okay, interesting. That's a very useful answer. Just sort of sticking on that theme, what about things like negotiating contracts and attitudes to doing business simply? I'm always struck by the cultural differences around the world, regardless of there's sort of different working practices, different know-how. What do you see with UK businesses or European businesses coming over to the GCC and dealing with that?
There could be two answers for this. One is a realistic answer, and one is a sugar-coated answer that you'll get on Google. I'll try to find a midway and answer it in the most appropriate manner. But culturally, we are different. Yes, of course, I won't deny it. I know that somewhere in London, even if there is a change of a train going from a station, you get a 15-day before a notice board, a letter, etc. Of course, we are not at that efficiency. You might wake up next morning and there might be a roadblock right outside your house in Dubai, and you have to navigate. So we are culturally different, but when it comes to how well attuned the government offices, the authorities are to help people progress through the setup, 100%. They welcome people wanting to come here. They're extremely helpful, from authorities to even the social authorities, the Dubai police, municipality. So they are extremely helpful, and in spite of us living in an Arab region, even though Arabic is the national language, everyone speaks English. So you would not have that issue that people are not communicating. So again, goes to show that culturally we are different, but everything that an expat needs to progress is there. Having said that, I always tell my clients, specifically those coming from the Western world, that take it with a pinch of salt. We are nowhere as bureaucratic as the Asian economies. And sorry to say this, but this is a hard fact of life for us Asians. I'm from India, but we're nowhere there. But yes, there could be scenarios where what you're after or what you're looking for, you might have to go through two government offices to get that answer. But the legway in that is consultants like ourselves. We'll do the company setup for you so you don't have to run around. You need any support locally to find a real estate, we'll do that for you. Or we'll let you know that, okay, this is a company, a real estate provider that you can trust. So I think there are avenues to make sure that you don't get stuck in these scenarios. You just have to be mindful that, okay, while I might do this on my own in the Western region, perhaps here I need to take help of an expert. I think it comes down to that.
Okay, that's very, very helpful. Okay, so I'm going to move on to some of the other questions that I've got in the Q&A. So there's one in here that says that there is a business that is an employee-owned business here in the UK. How will that affect setting up in the region when you mentioned a corporate shareholder?
Very, very valid question. So Essentially, like I said, that we do have an ultimate beneficial owner regime or guidelines or regulation that defines what an ultimate owner should look like and what percentage that entails. So essentially, when it comes to conversation like this, in order to define it on paper, or define it from a compliance perspective, we would take that into consideration and see, if there are employees that own 25% or more, or 10% and more, in case no one naturally owns 25% and more. Also, when it comes to employee-owned organizations, there are two free zones that I mentioned earlier on, DIFC and ADGM, who do have regulation that is prevalent for ESOP, employee-owned organizations, and perhaps that would be a far ideal avenue and authority for them to set up the business, rather than maybe mainland or another free zone that does not have provision in its regulation for such a structure.
Okay, very useful. Okay, there's another question here. This is with regards to the UAE free trades or free zone companies. What are the type of headquarter services that can be offered? I suspect, I'm wondering if this person has businesses in the UK and India. So I guess, does that mean that free zone companies could be used to have a new holdco and be attractive as holdcos?
Yes, I think Swami can take this one, because this ties in a little bit with the new tax regime where the HQ services come under the eligibility criteria. Swami, I'll let you take on, and then of course, if there's anything to add from a legal perspective, I'll do so.
Sure, Akriti. Yes, it's for a headquarter companies, it's you can definitely evaluate UAE and the free zones. It's as such, it's if you are providing headquarter activity, it could be in terms of largely, again, this headquarter activity is not necessarily can be defined in a few words, right? It's more in terms of it's not an exhaustive definition of headquarter activity that will be provided under the regulations. It's as Akriti was mentioning, this is something that it's not bureaucratic, but at the same time, as long as you are sticking to the spirit of the law, the interpretation, if it's the headquarter activity, what does the headquarter activity entail? The headquarter activity entail that it's direction, management, operational, right? So these are the ones at the company level or the group level that you are looking at providing the direction or the management, or it's in terms of the operational efficiencies, or in terms of the cost savings, the benefits that gets distributed to the group companies. So these are generally the activities that should benefit the entire group as such. But if there are support services, we had a case wherein one of the companies came to us to validate the internal analysis, saying that, okay, it's the headquarter services that are being provided. It's a very, very large company. Everybody knows about this brand. Each one of us who are using the plastic cards would have come across these companies. The internal analysis was that it's an headquarter activity, but as per our analysis, it was not a headquarter activity, although it would fit within the words. There could be management, there could be the activity of procurement, but it has to be headquarter activity. If there is no headquarter or the group benefit as such, then it's unlikely to be treated as a headquarter activity.
Okay, so essentially what I think you're saying is there needs to be substance to the headquarter activity. You can't just have a nameplate, which I think you mentioned before. And so you'll need to hire people, have an office, and actually undertake proper management activities.
So there is one layer up to this. Yes, that is the substance is the first layer. The second aspect is in terms of who is that benefiting. For example, it's a marketing activity. Whether it's benefiting for the entire group, or are you only marketing for yourself? So that's the question that arises. Then the aspect procurement, whether it's for the overall group. So those are the aspects that needs to be kept in mind.
Okay, that's very helpful. Okay, another question with regards to intellectual property and trademarks, design rights. Are there any challenges that businesses coming to the region face around that?
In terms of the intellectual property, it's yes, in terms of the documentation, I would not say it as a challenge. There are opportunities, which it's one of the questions that if I have to address another question which is there on the Q&A, it's in terms of the how does the Qatar tax benefit apply for the technology companies as such, or science and technology park. So these are benefits or the incentives. There are incentives for looking at having the IP in each of the countries. It's Qatar and UAE, for example. It could be 0% tax on the qualifying income in UAE, and similarly in Qatar also it could be zero, depending on what is the time period, whether it could be 5 years, 10 years, depending on the technology or the IP as such. As long as this technology, broadly, it's the technology is something that it's the IP or the technology should be something which is of which is valuable, in the sense it's the technology that should be with that's something that it's should lead to development of a new product, or tech process innovation as such, or a kind where it's a low value, high value specialist technology, or a manufacturing technology as such. So those are the aspects. It's where there could be benefits. Of course, in terms of licensing or the monetization is something it's based on that there could be tax benefits as such.
Yeah. Okay. And what about, because in your presentations you talked about a transition towards common law. So with regards to the sort of protection of IP rather than the tax aspects to it, does this transition to common law mean that it is much easier and more robust to protect intellectual property now in the GCC?
Yeah, it's I would Agriti, I'll just take a couple of seconds, and then it's from the legal perspective you can throw better light on it. From the tax perspective, Darren, when we look at the common law jurisdictions, tax is a federal subject, and the same federal law is something that is applicable across, irrespective it's a free zone or the mainland as such. In terms of where to house the IP, it could be a free zone entity. And free zone includes these common law jurisdiction free zones as such. It's some of the structures that we looked at, whether it's in terms of the family offices, whether in terms of a company in any of these regulated free zones as such. From the tax perspective for the IP, that is how we can look at. From the legal perspective, Akriti, over to you with some.
Thank you. Thanks, Swami. So like Swami said, that it is definitely an opportunity. The IP business as such, or the activity of a business holding its IP in the UAE, from a legal perspective, like the case was with the employee-owned organization, some avenues, some authorities will be far more suited for this kind of activity as opposed to other authorities, and simply because they have more supportive regulations. They also have more standardized and streamlined processes when it comes to IP activity, and that could entail them understanding how that activity operates, because it's very important to, and that's why in my session I said that the first step for any entity is to understand how they are going to be structured and where they are going to set up that entity. So while for an IP business they would still need to comply with the overall regulations when it comes to corporate tax, legal, but certain free zones would be far better at understanding what entails holding an IP and how they must comply through the various throughout the year for various aspects of operating. So it could mean maybe for IP businesses, there is a specific questionnaire that needs to be completed at the end of each year when it comes to your annual confirmation statement. It could also mean that the free zone might ask you to declare what that IP is. It could also mean that it needs to be a free zone that needs appropriate disclosures of the IP in the financial statements. So I think from a legal perspective, setting up the entity with the IP activity per se not really important, but understanding what would be the future impact and consequences of that activity being carried out, and the structure that you take up and the avenue where you set up the entity are some very important questions. Swami, I hope I covered that from a legal perspective. Please add on anything if I've missed out.
Yeah, Kriti, you covered it. You covered it. Darren, any further questions that you have on?
I think there is one other question, quite interesting. Darren, would you mind if I'm sorry, I just stepped in, but one last question, I think, which said, and we're short on time, but very quickly. Also, is it necessary to set up a proper structure with employees in a proper office, or could you just set up a virtual office and invoice from this virtual office with no employees? Inherently, UAE and other GCC countries have been jurisdiction where they've been tax havens. So you've got zero taxation. So essentially, this structure would work. It still works. So you're still able to set up an entity to carry out certain basic activities wherein you can have a virtual office. And most free zones offer you a virtual office. That basically means you have a smart office or a desk space that you can utilize for X number of hours on a monthly basis. And essentially, you wouldn't need to have employees, but at least the proprietor in today's time would need to get a residency through that company to be able to operate the entity in terms of approach various authorities, open a bank account. So while yes, this structure is still possible, an entity can still go for virtual office, but to operate completely without substance might not be an ideal scenario, specifically given the new regime that's come up.
Yeah, and I think Swami covered that earlier on when he said that the main issue.
Sorry.
There could be businesses. Yeah, sorry to interrupt, Darren. There could be businesses which can be set up in a virtual mode or with a single desk. It's like a critical check.
Activities. Yes.
Some of the investment activities. If it's a one-man company and the person is here, sets up all these investments. It's pretty much investment is not, the decision is not something that you do every day, right? It's unless you are into trading. So those kind of activities, yes, there is still a possibility as long as you are able to establish the substance, document that substance aspect. We can talk through, understand the specific cases and advise better, because all the substance or the commercial aspects needs to be looked at. It's all very, very factual. That needs to be looked at from that particular industry, from that particular activity that are being proposed to be carried out, the people who get involved, and the frequency, a lot of things, the documentation. So all those aspects, we need to be looked at, and then we can definitely advise.
Absolutely fabulous, and I think that probably rounds it up nicely. So thank you, Swami and Akriti. That was a whirlwind around the GCC. Thank you, everybody, for attending. Please reach out to us if you want further support, have further questions, and I wish you a good rest of the day. Thank you very much.
Thank you very much, everyone. Thank you.
Thank you very much, everyone.
Thank you. Cheers.
Take care.
Bye-bye.
Thanks.